So our provision for depreciation account. So we look at the question and fish out the first year and identify the assets that were there and move on. So the first year is 2006, right? 2006. But here we have two assets, asset A and asset B. So we may want to label them, especially because the methods are different for them. A is straight line and B is reducing balance. Okay, so 2006, let's check. We bought two assets all on 1st January. So they are all going to spend 12 months. So asset A would attract 1 million times the rate is 10%. So that is going to give us 100,000 for asset A. Asset B is 20%. So the cost 2,400,000 times 20%. We are not doing 3/12 or 9/12 because both of them were bought on 1st January 2006, right? And B is reducing balance, but in the first year, we haven't charged any depreciation to less from. So it's still going to be the cost times the rate. So 2,400,000 times 20%. Yes, I think that's 480,000. Please confirm the figures for me, I beg you. Okay, so 2,400,000 times 20%. Yes, 480,000. So it means for 2006, cumulatively, we have a total depreciation of 580,000. So we go into the provision for depreciation account and put in 31st December 2006, profit and loss. You can write it in full, profit and loss, or you can do P&L like this, 580,000. So that is for 2006. We didn't sell any asset to debit anything. So we balance and move on to the next year. Okay, so our carry down will be $580,000 as well. Okay. So we move to the next year. So this will be carried on to 1st January 2007. Balance brought down 580,000. Okay. So we are now in the year 2007. So we are going to calculate depreciation for 2007. Okay. So you just do it year by year. Your analysis, don't rush. So 2007, asset A would still be there, right? So it's still going to get the 1 million times the 10%. So we'll still have the 100,000 as the depreciation. Now, asset B is also going to be there. But because the method on asset B is reducing balance method, it means that we pick the cost and we less the previous depreciation from it. That's the reducing balance. You less the previous depreciation from it before you apply the rate. So let me take it again. Because asset B is using the reducing balance method. Let me get rid of this thing here. Okay. So because we are using the reducing balance method, in the second year, this is how the depreciation will be. We pick the asset, cost, and we less the previous depreciation we charged. So in this case, the depreciation we've charged is only this 480,000. Before we multiply the 20%, that's the reducing balance method. So you see, it's very simple. So let's do the calculations and see how much we are getting. So 2,400,000 minus 480,000 times 20%. We are going to get 384,000. Okay. So 2007, altogether, we have 484 as the total depreciation. So we come into the account and credit that 31st December 2007 profit and loss 484. 484,000. So you see that it's very simple, right? So we balance the year 2007 and move on to 2008. So I think this will be 1 million and but you people are making me do mental here. I don't like what you people are doing. Okay, 1,064,000 as the total. 1,064,000. If you are confused about something, I'm here. Prompt me. So balance carry down 1,064,000. So let me underline the totals and carry on to the next year. Okay, so 1st January 2008, balance brought down. We have 1,064,000. So we are now in the year 2008. So let's calculate the depreciation. Let me do it here. 2008. So asset A, was it in the business? 2008. The answer is yes, because it was sold on 31st December 2008. So it means the asset was still available. So we charged 1 million times 10%. And we are going to get our normal 100,000. Okay, now asset B, was it there? Okay, so sorry, asset A was not even sold in the first place, so we didn't even have to do speak about it being sold. Now asset B, as it were, was the one that was sold, but it was even sold on 31st December, so we still have to calculate depreciation on it. But again, it is reducing balance method. So look at it. We are going to pick the cost, 2,400,000, and we are going to less all the depreciations we have calculated so far from it. So if you followed, the depreciation we've calculated so far on this asset is the 480,000 as well as the 384,000. So you have to less all of them from it before you apply the rate 20%. That is the reducing balance method. Okay, so let's do the calculations and see how much we'll get. 2,400,000 minus 480,000 minus 384,000. We multiply by 20%. We are going to get a figure of 307,200. Remember, another asset was bought, which is asset C, was bought in 2008. Right? So that asset is also going to take some depreciation, asset C. Now, the question is, what is the depreciation for asset C? Asset C was bought on 31st December 2008. So 2008, there will be no depreciation for asset C because it was not there January, February, March, April, May, June, July, August. Even in December, it was not there. So asset C would get zero depreciation in 2008. So that is what I meant by you have to consider it. Because it was bought in 2008, you have to consider it. But after analysis, you would realize that the depreciation will be zero because you don't have to charge any depreciation. Okay, so for the year 2008, this is the depreciation we have 407,200. So you come into the account and do your credits. 31st December 2008, P&L 407,200. And because we sold asset B in 2008, you have to debit with the accumulated depreciation on that asset. So let's get the accumulated depreciation on asset B. I think it's so accumulated depreciation for asset B is equal to, I think the first year we charged 480,000 plus the second year 384,000 plus the third year 307,200, giving us a total of 1,171,200. So this is the accumulated depreciation. You come and debit in the provision for depreciation account. So 31st December 2008. That's the date we sold it. Disposal 1,171,200. Then you balance it and finish up your account, right? Very simple, very, very simple. Depreciation is very sweet. So the total is going to be 1,471,200. 1,471,000. So one will less the 1,171. We are going to get a balance of 300,000 as the balance carried down. Yes, December 2008. My students are silent. I hope everything is okay. If there's confusion, please let me know. So we bring it down to 2009 first, January 2009. Balance brought down 300,000. Now again, let me show you some sense here. If you check, you see, we're depreciating two assets, right? Asset A and B. Now asset B is no more, so it has gone away with all the depreciations. So the current balance on our depreciation account is 300,000. And if you do the math, you realize that the 300,000 is a representation of the depreciation we have charged on asset A for year 1, year 2, and year 3. Okay, so that's the essence of when you dispose an asset, every depreciation on that asset should be removed from the provision for depreciation account. That is why we debit with the accumulated depreciation. Now let me hit again on the reducing balance. If you are using the reducing balance method, in the first year, it looks like the straight line because you apply on the cost. But in the next year, you have to less the previous depreciation from it before you apply the rate. And I think it's very simple. You don't have to bother your head about it. Okay, so my faithful professors, any question, any confusion? Okay, no question, no confusion. Let's do the disposal, right? I hate doing the disposal because I feel my students can do that. Just pass the corresponding entries and you are good to go, right? So we first look at the asset account and pass the corresponding entry. So we are going to debit disposal account with the cost 2,400,000. Then we come to the provision for depreciation account and pass the corresponding entry. And then we record how much we got from selling the asset, which is in the question, the sales proceeds. Then you balance off to get your profit or loss. So let's quickly do that. Let me copy the disposal account from the previous one. Okay. Okay, so let's go to the machine account and the first disposal, 31st December 2008. So we come into disposal, 31st December 2008. The narration will be machine. We put the amount 2,400,000. After that, you go to the provision for depreciation account and also pass the corresponding entry for the disposal. So it was debited here. In disposal, it will be credited. So 31st December 2008, provision for depreciation. And how much did we get there? That was 1,171,200. Then finally, you record the proceeds, how much we got from selling the asset. And we were told that it was sold for 1,261,000. 1,261,000. Then you now balance it and see whether you get a profit or loss. In this case, are we going to get profit or loss? This is 2,400,000. This is 2,400,000 and something. Yeah, so I'm sure we are still going to get another profit. So let me do the additions here. This is 2,432,200. So the difference is 32,200, and that is the profit and loss. So that's your disposal account. Very simple. Now, I think we are to do the profit and loss extract and the balance sheet extract. Well, those extracts are very simple again, but let me be sure that my students are okay with the asset account and the depreciation account. So please, question time. Please ask me question. I beg you, ask me question. Ask me. Ask me. If not, let's do the profit and loss extract. See, the profit and loss extract is also very simple. You just go through the 3 accounts you have prepared and you'll be passing the corresponding entries. But let's do it here. Okay, so I always prefer the T style because that will make your extract very simple for you. So profit and loss account extract. That is what you write like that. So this is what you do. Go through the account. You realize that in the machine account, there is no profit and loss account for you to post. So come to the provision for depreciation account, okay? Wherever you see profit and loss, pass the corresponding entry, that's all. So in the first year, 31st December 2006, you have P&L, which has been credited here. So in your profit and loss account, you too go to the debit side, indicate 31st December 2006, provision for depreciation, because that is the account from which you are doing the corresponding entry. Then you put the figure there. That's 580. 580,000. Right? Then you go to the next year, which is 2007, right? Another P&L. Okay, I think there are questions. I'm seeing, oh, okay, thanks. As Ella, is that to me or? Okay. Yeah. Well, okay. I won't comment on that. So 2007 too, we passed the corresponding entry. So 31st December 2007, you go into your profit and loss account just like that. So the profit and loss extract is also not difficult. Just pass the corresponding entries. Okay. So 31st December 2007, provision for depreciation. You put in the figure there, right? 484. 484,000. That's all. Then you go to the next year, pass the corresponding entry, right? Which is 2008, 407,200. 407,200. 31st December 2008. Provision for, as simple as that. But again, in your disposal account, you have another P&L. You have to pass corresponding entry. So that was on 2008. So do it on the same line as that year, 2008. You are going to indicate disposal, 32,200. So that's how you do the extract. Do them year by year. And when you finish the year, you have to underline the year because there's nothing there you are going to do again. That's all. That's your profit and loss extract. Let me speak about the balance sheet extract, and it is also very simple. Since you have done the balance sheet, you remember the final account of a sole trader. In the balance sheet, you show the cost of the assets, and then you less accumulated depreciation, and you get the net book value, right? So that's how you prepare the balance sheet extracts. In fact, you people, your silence is killing me. Oh, talk to me. What are you people doing? Okay, so balance sheet extracts. So this is what you do. Show the cost of the asset, accumulated depreciation, and then net book value, net NBV. Right. So you are going to do it year by year, every year. So 2006. In this question, 2006 is the first year. Look at where you pick the information. Come to the asset account and pick the balance carried down. the closing balance for that year, 2006. So it's 3,400,000. So put it under the cost, 3,400,000. And then the accumulated depreciation, go to your depreciation account and also pick the balance carried down for that year. So the balance carried down for 2006 is 580,000. Then you put it there, 580,000. And when you less, you get the net book value, right? So 2007, the same tip. Go to the asset account, pick the balance carried down for 2007. Come to provision for depreciation account, pick the balance carried down for 2007. So in the balance sheet, you are just picking carried down from the asset account and the depreciation account. That's all. That's all that you do in your balance sheet extract. So it's very simple. Balance carried down in the asset against balance carried down in the provision for depreciation account. So let me do that for 2007. 2007 carried down for depreciation is 1,064,000. 1,064,000. Good. So the last year, which is 2008, take the carry down from the asset account. 2008 balance carry down for the asset, 2,600,000. 2,600,000. I'm going to pick the carry down in the depreciation account for 2008. That is 300,000. Good. So to get the net book value, just less the depreciation from the cost in that order, and you are done with your balance sheet extract. Good. So that's all. Any question? Okay, so let me quickly use the remaining time, 4 minutes, to talk about our next agenda for tomorrow. Tomorrow, God willing, we are going to solve our final, very complex but simple illustration where the policy of depreciation comes to play. There are some companies, when they buy the asset, even in October or September or whatever, they still require that you charge full year depreciation. And there are some companies too, in the year they sell the assets, they don't charge depreciation. So even if the asset was sold in December, if you are given that policy, you don't calculate depreciation on that asset which has been sold. So these are some of the policies I want us to look at, God willing, tomorrow, and solve the final question and wrap up with provision for depreciation. So please, God willing, tomorrow, come with all the questions and all the confusions. So just so we prepare our mind, these are the policies. Some companies charge full year depreciation in the year of acquisition, no depreciation in the year of disposal. So we'll look at that, God willing, tomorrow. Let's end the class with questions, or if there are no questions,